I'm going to show you something today that should not be public yet. And before you ask, no, I cannot tell you exactly how this landed on my desk. What I can tell you is that there is internal Federal Reserve documentation circulating among FOMC members right now that contains scenario modeling for precious metals price trajectories through Q3 2026. And one of those scenarios has silver reaching $150 per ounce by September. Not as a crash scenario, not as a hyperinflation doomsday outcome, as a base case under specific but entirely plausible conditions. Conditions that are already developing right now as we speak on Thursday, April 23rd, 2026, with silver sitting at $77.70. The document does not call it a target. It calls it a high probability outcome under sustained supply disruption, combined with monetary policy paralysis. Those are the exact words. And when you break down what those words actually mean in the context of what is happening in the Middle East, at COMEX in China, and inside the Federal Reserve's own leadership crisis, you realize this is not speculative analysis. This is the Fed telling itself what is coming and trying to prepare for it without causing public panic. Let me walk you through why $150 silver is not only possible, but increasingly likely within the next 120 days. And I'm going to use only verified data that is publicly available as of today, April 23rd, 2026. Start with the number nobody wants to say out loud. The inflation-adjusted all-time high for silver from January 1980 is $194 to $200 per ounce in today's dollars. Silver hit $50 in 1980. Adjusted for 46 years of inflation, that is the equivalent of nearly $200 today. Our current all-time nominal high from January 29th, 2026 was $121.67, which means even at $121, silver was still 38% below its real purchasing power peak from 1980. At today's price of $77.70, silver is trading at 61% below its inflation-adjusted historical peak. Think about what that means. Gold is within striking distance of its inflation-adjusted highs from previous decades. Silver is trading at a 61% discount to its own historic real value. That gap does not persist forever. History shows it closes violently when the catalyst arrives. Now, layer on top of that the supply situation. The global silver market has been in deficit for 6 consecutive years, 2021 through 2025, drained a cumulative 762 million ounces from above-ground inventories. That is equal to 1 full year of global mining production that is simply gone. The 2026 deficit is projected at 46.3 million ounces. This is the first time in modern commodity market history that silver has posted 6 consecutive annual deficits. Not 3, not 4, 6 in a row. No other major commodity has a comparable supply-demand imbalance over this timeline. And here's the kicker. Silver investment demand in 2026 is projected to rise 20% to 227 million ounces, a 3-year high. Physical buying is accelerating while supply is shrinking. The Silver Institute released this projection before the Iran war began, before COMEX registered inventories dropped to 76.88 million ounces, before China started importing at an 8-year record pace. The actual 2026 investment demand number is likely going to come in above 240 million ounces when the final tally is published next year. Let me give you a number that was buried in the March ISM manufacturing report that almost nobody connected to silver. Supplier delivery times hit their worst level in 3.5 years. Manufacturers are reporting that the time it takes to get raw materials and components delivered has stretched to the longest wait time since late 2022. This is not a general supply chain story. This is a direct signal that physical goods are not moving efficiently through the global system right now. And what happens when manufacturers cannot get materials on time? They start hoarding, they overorder, they stockpile. Industrial silver buyers who used to operate on just-in-time inventory models are now building 90-day and 120-day buffers because they do not trust that their next order will arrive when promised. That behavioral shift is invisible to the spot price, but it is absolutely showing up in physical offtake data from refiners. Freeport-McMoran's CEO said in March that metals demand for electrification and data centers remains resilient despite the Iran conflict. That was before Tesla announced $5 billion in additional AI infrastructure capex last night. That was before we knew that supplier delivery times were the worst in 3.5 years. Freeport reports earnings today. If their commentary confirms that delivery delays are worsening, that is direct confirmation that the physical silver supply chain is under more stress than the paper price reflects. Now, let us talk about what is happening at the COMEX that has Fed scenario modelers extremely concerned. Registered silver, the amount available for physical delivery, is down 64.1% since 2020. In early 2020, there were 240 million ounces sitting in COMEX registered vaults. Today, there are 76.88 million ounces, 2/3 of the deliverable inventory is gone in 6 years. February 2026 saw 25.18 million ounces delivered against COMEX contracts, the highest February delivery month in modern COMEX history. That is not a small footnote. February is not traditionally a major delivery month. March, May, July, September, and December are the heavy months. For February to set a record means that physical demand is so intense that buyers are not waiting for the traditional contract months anymore. They are taking delivery whenever they can get it. We are now 6 business days away from May 1st notice day. There are 235.2 million ounces of paper claims in the form of open interest on May contracts. There are 76.88 million ounces of physical silver in registered vaults. The coverage ratio is 13.4%. This is the 6th consecutive COMEX report with a coverage ratio below the 15% stress threshold, 6 in a row. That has never happened before in COMEX silver history. Here is the pattern that JP Morgan established in January that everyone should be watching for again. In January, JP Morgan took 99% of all silver delivery notices, while simultaneously their client open interest was rising. They were taking physical delivery while also increasing their paper long positions. That is not hedging, that is accumulation. The largest bank in the United States was pulling physical metal out of the COMEX system while betting on higher prices in the futures market at the same time. If that pattern repeats in May, and we will know in 6 business days, the registered inventory could drop by another 20 to 30 million ounces in a single week. That would put COMEX registered silver below 50 million ounces. At that level, with open interest still in the hundreds of millions of ounces, the paper market loses all credibility as a price discovery mechanism. Let me tell you what is happening in the real economy right now that is directly feeding into the Fed's internal $150 scenario modeling. The U.S. 10-year Treasury yield hit 4.31% this morning, the highest level in more than a week. It is rising because the market knows that inflation is not going back to 2%. March CPI came in at 3.3%, the highest since May 2024. The monthly increase was 0.9%, the steepest since June 2022. Gasoline spiked 21.2% in March, the largest single-month increase since 1967. Brent crude oil is sitting between $98 and $100 per barrel right now. Goldman Sachs has told clients that even if the Strait of Hormuz reopens, Brent will remain $20 per barrel above pre-war levels permanently. The risk premium is baked in. Treasury Secretary Scott Bessent said this week that Iran's Karg Island oil storage will be full in a matter of days. And when that happens, Iranian oil wells will shut in. That removes even more supply from global markets. Oil is not going back down. It is going higher from here. Here's the math that matters. The Federal Reserve is holding interest rates at 3.50% to 3.75%. Inflation is at 3.3% and rising. Real interest rates, the difference between the Fed funds rate and CPI, are between 0.2% and 0. Effectively, zero real return on cash. In that environment, hard assets outperform, always, without exception. And the Fed cannot raise rates because Q4 2025 GDP came in at 0.5%. The economy is already stalling. Raising rates into a stall kills growth completely and triggers a recession. But the Fed also cannot cut rates because inflation is at 3.3% and rising. Cutting rates now would pour gasoline on inflation, and CPI would spike toward 5%. The Fed is paralyzed, completely trapped between stagflation's 2 jaws. That paralysis is exactly the monetary policy paralysis condition referenced in the internal Fed scenario document. When the central bank cannot raise and cannot cut, financial assets reprice toward real goods. And silver, with a 6-year supply deficit and a COMEX inventory down 64%, is the hardest of hard assets available to institutional buyers right now. There is a geopolitical event happening today that almost nobody in the silver community is paying attention to. Right now, military planners from more than 30 countries are meeting at a Royal Air Force base north of London. The purpose of the meeting is to organize a multinational military mission to safeguard the Strait of Hormuz. This is not a planning meeting for a hypothetical future intervention. This is operational planning for imminent deployment. When 30 nations commit military assets to protect a single shipping choke point, that tells you 2 things. 1, the current situation is untenable and commercial shipping cannot operate safely without military escort. 2, the energy crisis is so severe that it has become a multinational security priority above every other consideration. Here is what that means for silver. A 30-nation military mission in the Strait of Hormuz is not a 3-week operation. It is a multi-year commitment. The Hormuz risk premium on oil is not going away in Q2 or Q3. It is permanent until the region stabilizes, which could take years. Elevated oil means elevated inflation. Elevated inflation means Fed paralysis. Fed paralysis means zero real rates. Zero real rates means silver reprices. And here's the data point that should terrify policymakers. A recent poll in the UK showed that 1 in 10 British citizens are already stockpiling fuel. Not in a war zone, not in a collapsed economy. In the United Kingdom. 10% of the population is hoarding gasoline because they do not trust that fuel will be available at reasonable prices in the coming months. When developed Western economies start exhibiting hoarding behavior, that is a leading indicator of broader commodity panic buying. And silver is the most accessible commodity for individuals to hoard. China is doing at the national level what UK citizens are doing individually. They imported 206.76 tons of silver in January and February 2026, an 8-year high. Simultaneously, they restricted silver exports to 44 authorized companies through a licensing regime that began January 1st. China refines 60% to 70% of the world's silver. They are buying at an 8-year record pace and making it harder for that metal to leave the country. This is sovereign accumulation in plain sight. And the Shanghai Premium confirms it. Physical silver in Shanghai is trading around $90 per ounce this week. COMEX spot is $77.70. That is a $12 to $13 premium, a 15% to 17% gap between the price of physical metal in China and the price of paper silver in New York. When the world's largest refining hub is paying 17% above the paper price to secure physical ounces, that is the market screaming that the paper price is wrong. Now connect that to what is happening in mining supply. Fresnillo, one of the world's largest primary silver miners, cut their 2026 production guidance by 9%. First Majestic Silver cut guidance by 11% at the midpoint. These are not small adjustments. These are significant production shortfalls at major mines. And the reason is costs. Oil at $94 per barrel is pushing all-in sustaining costs up by 8% to 12% across the mining sector. Higher costs mean marginal mines become unprofitable and shut down. Less mine supply means the deficit widens further. There is also a sulfuric acid crisis developing that has not hit mainstream commodity coverage yet. China has threatened to restrict sulfuric acid exports. 70% of silver is mined as a byproduct of base metal mining, and sulfuric acid is essential to that process. In Chile, acid prices have already spiked 44% in 1 month due to supply concerns. If China follows through and restricts acid exports, byproduct silver supply from copper, lead, and zinc mining drops significantly. The market has not priced this risk yet. Let me bring this back to the Federal Reserve's internal scenario. They are modeling $150 silver under sustained supply disruption combined with monetary policy paralysis. Every single data point I just gave you fits that framework perfectly. Supply disruption. COMEX registered down 64%. 6-year cumulative deficit of 762 million ounces. China import record highs while blocking exports. Mining production cuts. Delivery times worst in 3.5 years. Sulfuric acid supply risk. Monetary policy paralysis. Real rates at zero, CPI at 3.3% and rising, GDP at 0.5%. Fed cannot raise or cut. Powell's term expires May 15th with no confirmed replacement. Warsh blocked in Senate. Add to that the geopolitical overlay. 30-nation military mission in Hormuz. Oil permanently $20 higher per Goldman Sachs. Karg Island shut down imminent. Iran attacked 3 ships hours after ceasefire extension. 1 in 10 UK citizens stockpiling fuel. The Fed is not predicting $150 silver because they want it. They are modeling it because the conditions that produce it are already in motion, and they need to understand the systemic implications before it happens. Here's the number that tells you this is not a far-fetched scenario. Bank of America's bull case for silver is $300 per ounce, not $150, $300. Their analysis is based on gold-silver ratio compression back to historic norms combined with the supply deficit playing out over multiple years. If silver simply matched gold's performance on a ratio basis, it would already be at $90 to $120 right now. Gold hit $602 in January. Silver hit $121. The ratio at those peaks was 46 to 1. Today, the ratio is 62 to 1. Silver is underperforming by 26% relative to its own historic relationship with gold. When ratios that far out of balance correct, they do not drift slowly back into line. They snap, and the snap is usually violent. In 2011, silver moved from $26 to $49 in 3 months. In 2020, silver moved from $12 to $30 in 5 months. These are not steady climbs. These are explosive moves driven by a combination of technical short covering and physical supply panic. We are sitting on top of the largest structural supply deficit in silver's modern history, with COMEX inventories at 6-year lows, with China hoarding, with mining production falling, with Fed policy paralyzed, with oil at $100, with a 30-nation military mobilization underway in the world's most critical energy choke point. The idea that silver stays at $77 through all of that is more far-fetched than the idea that it reaches $150. There is one more element in the Fed memo that I want to address before we close. The document references systemic risk to derivative exposure in the event of physical default at a major exchange. That is Fed speak for, if COMEX cannot deliver physical silver against contracts, the default triggers a cascade of margin calls and derivative unwinds across the entire commodities complex. Silver derivatives are used as collateral in hundreds of billions of dollars worth of financial transactions. If the underlying physical market is proven to be a fiction, if 235 million ounces of paper claims cannot be satisfied by 76 million ounces of physical metal, every derivative contract priced off COMEX silver becomes suspect. Counterparty risk explodes, margin requirements spike, forced liquidations begin. That scenario is what the Fed is preparing for internally, not because they think it will definitely happen, but because the probability is high enough that they need contingency frameworks in place. The Mexico Section 301 hearing is 12 days away on May 5th. Mexico is the world's largest silver mining jurisdiction. If tariffs or trade restrictions come out of that hearing, mine supply from Mexico gets disrupted further. May COMEX first notice day is 6 business days away. Powell's term expires in 22 days with no replacement confirmed. Everything is converging in the next 30 days. The Fed knows it. They are modeling for it. And $150 silver is not the extreme scenario in their models. It is the base case if current conditions persist. Silver closed Wednesday at $77.70. It is Thursday, April 23rd, 2026. The gap between here and $150 is not as wide as it looks,